Namaste and welcome to Retail Investing. So the markets have crashed. It's game over. It's time to sell all your equities. That is exactly what some people are calling me and telling me. Now, what has happened in reality is that the NIFTY has corrected to levels of 18,800 and the SENSEX has corrected to levels of 63,100. So a 5 to 7% correction from its peak. It's almost nothing for me, but for some people it's a big deal. So what I'm going to do in this video is to try to explain the three major reasons behind this correction, and there may be multiple reasons, but I'll be focusing on the three most important reasons from what I understand. So reason number one is obviously the war in the Middle East. Reason number two is the rise in American bond yields, and reason number three is the corporate earnings reports, and I'm talking about the quarterly results of the companies which have started coming out. So let's go to reason number one and discuss that a bit. So the war in the Middle East. If you have read the history of Israel's wars, you may have noticed that Israel's strategy is to fight short and fast wars and win a decisive victory as soon as possible. Now, in 1967, there was a war which has been named the 6-Day War. That war was over in 6 days. Then in 1973, they fought another war which is called the Yom Kippur War, and that war lasted, from what I remember, 2 weeks and 5 days. But this war, it began on the October 7th, 2023, and already more than 3 weeks have gone, but still there is no end in sight. Now, what I think, the major reason behind this war has got very little to do with the enmity between Israel and Hamas. And what I'm talking about is the India, Middle East, European Economic Corridor. Now, this thing was finalized in the last week of September, from what I remember, and this war began within just a month of that discussion. So what this economic corridor is going to do is that it is going to connect India to Europe via the Middle East. Now, the Middle Eastern countries that are involved, directly involved in it, are Saudi Arabia, the United Arab Emirates, and obviously Israel. And all these countries are playing a big role in it. Now, America is also playing a major role in this economic corridor. And so who exactly is left out? Which big Middle Eastern country is left out from this economic corridor? It's Iran, right? And they definitely don't like it. And you may have noticed that Iran is extremely proactive in this war, and they're also threatening to directly get involved in the war. Now, America has sent their naval ships, their warships in the region, and China also did the same. Now, if you have been following geopolitics and developments in world economy, you may have guessed it by now that this economic corridor is aimed at directly countering China's Belt Road Initiative, which has been a massive debt trap for many countries. Now, China obviously does not like that. So I hope it explains why this war is getting, so much big, and so many countries are feeling threatened to getting dragged into the war. So the economic corridor is a big reason from an investing perspective. That's what I take away from it. Now, another thing that I would like to mention is that because of this war, the crude oil prices are getting adversely affected. Now, when crude oil prices go up, which has already happened, the business economics of a lot of industries are badly impacted, because crude oil actually acts as raw materials for a lot of industries. And when the raw material prices go up, what happens is that the profit margins erode. And when profit margins erode, the companies get downgraded because their earnings report, it shows up on their earnings report. So that is another reason for correction. Now, crude oil prices, I don't think they can remain at elevated levels for a long time, but we cannot predict anything. It's impossible to predict crude oil prices, just like interest rates. So that is one reason. Now the next reason which I'm going to point out is reason number 2 is the sudden rise in American bond yields. Now what has happened is that the long-term bond yields, which is called the US Treasury, and now don't confuse it with the Reserve Bank of India's Treasury bills. The two are completely different things. So the American Treasury are the long-term bonds. Now they are offering 5% guaranteed returns to its investors. That's what the rise in bond yields mean. Now investors, whether it is an inexperienced retail investor or an experienced institutional investors, the psychology is more or less the same. We are all by default risk averse, so we always want to avoid risk. So if we are given two options, in which option 1 gives us guaranteed 5% returns without any risk, and option 2 gives us up to 20% returns, but there will be volatility and there will be risks, most of us are going to opt for option number 1. Even institutional investors do that, and it is evident from the fact that the foreign institutions have been taking out money from Indian equities and putting them into US bonds. Now you do not need to be a research analyst to figure it out that American bonds over a longer period of time can never give returns as high as Indian equities can or American equities can. But still the foreign institutions, that's what they have always been doing. They take out money from equities, and that is a big reason for the correction. Now another thing that the bond yields have always successfully done is that they have actually predicted recessions correctly every time in the past 50 years, and this increase in bond yields actually suggests a recession in the American economy. Now a recession in the American economy could mean trouble for a lot of industries across the entire world. The Indian IT industries is heavily dependent on its exports, on the services exports to America. So investors in IT companies, be careful about that. Now let's see if that recession actually happens. It will unfold in a few quarters. So that was reason number 2. And reason number 3 is the corporate earnings. The earnings reports, the quarterly earnings reports for many companies have already been published, and for some of the companies it is still pending. Now the most of the companies have reported good profits and also growth in their profits. But what has happened is that these profits have not met the expectations of most analysts. And when the profits do not meet the expectations of analysts, what they do is they downgrade the stocks. And when stocks get downgraded, selling activities go up. So this has happened. I'm not getting into the details of any companies, but overall this has happened to some extent. So that was the reason number 3 for the correction. So what should retail investors do in a situation like this? Ideally nothing, because that is exactly how most of the wealth in stock markets get created, by doing nothing and sitting down and probably sleeping, and that is exactly what I plan to do. Now the worst thing that retail investors can do in a situation like this is to sell. You see, to create wealth in the stock market, we need to sell to the optimists and buy from the pessimists. Right now what is happening is that the pessimists are selling in panic mode, and their selling is driving down the prices. So I don't want to sell in a situation like this. If this is a time for something, if people have money, for long-term investors, this is a great time to buy, in my opinion. Even though this is not a recommendation of any kind, I'm just sharing some historical data with you. And now many people are also saying that this is a bull market correction. Now what a bull market correction is, that the selling volumes, they do not go up significantly, but still the prices correct. And now when the selling volumes are not going up and the prices are correcting, that means that there is absence of buying. Now so this has been termed as the bull market correction. And in a bull market correction, the correction phase is brief, and it is followed by the continuation of the bull market. And I think this will turn out to be true. and let's wait and watch what happens next. Now, before I end the video, I would like to mention what I heard from one of the interviews of a very famous fund manager by the name of Mr. Nilesh Shah of Kotak Securities. What he said is that the domestic institutions, the mutual funds, they are holding onto 2.5 lakh crores of capital which can be deployed. Now, if they deploy that capital at this time, it's good news for mutual fund investors. The returns are likely to be above average, definitely. And if you have a look at the buying and selling data, the institutional buying and selling data on the website of the National Stock Exchange, you will find that the foreign institutions have been heavily selling and the domestic institutions have been buying almost the same amount on a daily basis. So I can see where Mr. Nilesh Shah is getting with his statement. So that was my assessment of this situation. If you found anything valuable from this video, please consider liking and sharing. And if you don't want to miss future videos on investing, please subscribe. Thank you very much for joining, and I'll see you in the next one. Jai Hind.